In 2000, a Cisco employee was worth $11 million on paper. By 2002, he owed the IRS more than his stock was worth. He never sold a single share. This is the realization problem, and it's quietly destroying portfolios right now. There's a brutal truth in investing nobody talks about. The number on your brokerage app isn't real money. It's a promise, a possibility. And the gap between what you see and what you actually keep, that's where fortunes disappear. Today we're breaking down the 4 ways paper gains lie to you. The fourth one is what wiped out an entire generation of dot-com millionaires. Let me tell you about the cruelest financial story of the last 50 years. Cisco Systems. Late 1999. The stock hit $80 a share. Employees who'd been granted incentive stock options were, on paper, multimillionaires. And here's where it gets dark. Many of those employees exercised their options when the stock peaked. The IRS treats that exercise as taxable income based on the spread between the grant price and the market price. So if you exercised options on stock worth $1 million, you owed the alternative minimum tax on that million. Even though you didn't sell. Even though you held the shares. Then the bubble popped. Cisco fell from $80 to $8. A 90% collapse. The employees still owed the tax on the gain that no longer existed. The IRS didn't care. Some lost their houses. Some declared bankruptcy. Their paper fortune became a real liability. And the lesson is permanent. A gain isn't a gain until it's in your bank account, after taxes, and it's spent or reinvested wisely. But here's the trap most retail investors fall into today. Quick question. If your stock goes up 40% in 1 year, how much did you actually make? Most people would say, 40%. They'd be wrong. If you sell within 12 months, the IRS taxes that as short-term capital gains. At the highest federal bracket, that's 37%. Add state taxes, California takes another 13.3%, and your 40% gain just became a 23% gain. Almost half, gone. Now compare that to long-term capital gains. Hold the stock for over 12 months. The federal rate drops to 15 or 20%. That's why Buffett famously said his favorite holding period is forever. It's not just patience. It's math. Every time you sell, you're voluntarily paying the government to reset your portfolio. Activity is the enemy of compounding, and the realization problem makes that worse than most investors realize. Here's a story I want every employee with company stock to hear. In 2001, an Enron senior accountant named Charles Prestwood had retired with his entire $401,000 in Enron stock. On paper, he was set for life. Within months, it was worth nothing. Same story repeated with Lehman Brothers in 2008. With WorldCom. With Bear Stearns. The pattern is identical. Employees concentrated their net worth in their employer's stock because the company gave them a discount. Or because they'd believed in the mission. That belief was the trap. Here's the math. If you own one stock and it doubles, you made 100%. If you own one stock and it goes to zero, you lose 100% of everything. Concentration creates the illusion of wealth on the way up. And the reality of catastrophe on the way down. The paper gains in your concentrated position aren't gains, they're a margin call waiting to happen. But the deepest realization problem isn't financial. It's psychological. There's a behavioral bias economists have studied for 40 years. It's called the endowment effect. And it explains why so many investors hold losing positions far too long. The principle is simple: we value things more once we own them. Daniel Kahneman won the Nobel Prize in 2002 for proving this. Studies show losses feel about 2 times more painful than equivalent gains feel good. So when your stock is up 50% on paper, you don't sell. Because selling means admitting it's the maximum. And when your stock is down 50%, you don't sell either. Because selling means admitting you were wrong. The result? Paper gains evaporate before you realize them. Paper losses turn into real, permanent capital destruction. Buffett addressed this directly. He said the most important quality for an investor is temperament, not intellect. Because the math of investing is simple. The psychology is everything. Knowing when to convert paper gains into real ones requires you to overcome a bias your brain is hardwired to obey. Here's the principle worth remembering. Your portfolio's value is a hypothesis. Until you sell, pay your taxes, and the cash hits your account, it's just a number on a screen. Real wealth is built on three things: patience to hold quality long enough for tax efficiency, discipline to diversify away from concentration risk, and the temperament to act when fundamentals demand it. Not when your emotions do. So here's my question for you. Have you ever held a winner so long it became a loser? Or sold too early and watched it run? Tell me in the comments, I read every one. And if this changed how you look at your portfolio, hit subscribe. Tomorrow we're tackling something every value investor needs to hear: the difference between cheap stocks and value traps. It might save you from the next big mistake.